very much, Mike, and let me reiterate also my personal gratitude for the opportunity to share with you the outlook on the Chinese economy. As you mentioned, against the backdrop of a very challenging global economic outlook, China indeed stands out as the only major economy expected to recover and actually accelerate this year. Now, in my short presentation, I want to touch upon three broad messages. The first message is looking back a little bit to last year, basically because it determines the starting point. And of course, if we look at last year, China's economy slowed sharply, and that was due to several mostly domestic headwinds, and I will talk a little bit about that. Then secondly, I want to talk about the near-term outlook, especially for 2023. And as mentioned, we expect China's economy to recover in 2023. And in our view, that's supported by a broad growth policy pivot where several macroeconomic, but also public health and regulatory policies are expected to provide a boost to a recovery of the domestic economy. And then finally, I will conclude also with some policy implications, focusing both on near-term policies to essentially solidify the expected recovery, but then also talk a bit about medium-term policies to help rebalance China's economy and set it on a sustainable medium-term path. So let's start with 2022. If we look at the growth dynamics last year, what we see is that there was a bit of a stop and go economic performance, in large part driven by the dynamics of the pandemic, where we saw recurrent outbreaks that then in turn caused the imposition of restrictions, localized restrictions on mobility, which in turn led to dampened economic activity, and those slowdowns were then followed by uneven recoveries. For the whole year, we expect growth to have slowed to 2.7%. Last year, actually, in fact, coincidentally, in last year's GDP growth number will be released today, so we'll see where we ended up. But market forecasts widely expect growth to have slowed to below 3% last year. Now, if we look at what's driving that, in effect, we see that especially domestic demand, both investment and consumption slowed markedly last year, and it was only partially offset by relatively resilient export performance, at least for most part of the year. Also, we see that in the last quarter, exports weakened substantially, foreshadowing basically the slowdown in the global economy and weaker external demand, as mentioned by Ayhan in his presentation. Now, in addition to the impact of the COVID pandemic and measures to contain it for most part of the year, the other big story in China is, of course, the slowdown in the property sector. China's housing market has been embroiled in essentially a liquidity squeeze, which in turn caused financial distress among developers, which in turn eroded confidence by home buyers, which weighed on real sector activity in that important sector that is estimated to contribute about a quarter of China's GDP directly and indirectly. And what I'm showing here is some key indicators for last year, and we can see that investment has fallen and contracted sharply in the sector, contributing or weighing, dragging down overall investment in the economy, despite infrastructure investment offsetting this to some extent. We see that essentially sales are down, and so is revenue. So in a sense, the sector has really been in a slump last year. Now, as I move to the outlook later in this presentation, of course, our expectation and market expectation is that, in a sense, the slowdown has hopefully bottomed out, and we expect some recovery next year. Now, offsetting the weakness on the domestic side, as I mentioned, we did see a positive export or quite resilient export growth for most part of the year. But importantly, if we focus on the near term and the forward look into this year, we see that exports have slowed markedly in basically starting in November, in line with what we see globally, where we see a major downturn in trade activity and soft demand. For example, export orders have softened significantly, not just here in China, but elsewhere. And that was compounded to some extent by the supply side, where, again, because of pandemic situation, some disruptions also occurred there. Now, if we look at the whole year, so we do see that net exports contributed positively to growth, and that we, of course, see the mirror image of that in a widening current account surplus, which contributed positively to growth last year. Now, moving beyond real sector and growth dynamics, what is interesting in China's case, and again, China is perhaps a case in point for the broader region in East Asia and the Pacific, we haven't seen the same sort of inflationary pressures that many of the other major economies experienced, with especially core inflation remaining below 1%. Headline inflation has picked up a little bit in the last quarter of the year on higher food prices, but overall inflationary pressures seem to remain relatively contained. Inflation expectations seem to be well anchored. Now, of course, this is something that needs to be watched now that we expect a recovery in domestic demand, but at least so far, China, to some extent, has defied the global inflation trend. Associated with the slowdown and the relatively weak economic activity, we also see that labor market pressures have persisted throughout the year, especially youth employment remains very high, partly because, as you can see from the right-hand chart here, job creation has slowed down markedly in the last 3 years. It's actually gross job creation, so just the sheer number of jobs created, have fallen below the official government target, and net job creation, which basically is the difference between new jobs created and jobs lost, have declined significantly. And that, of course, in turn has made it very challenging for new labor market entrants, graduates, to find employment. And as a result, this has received quite a bit of policy attention by policymakers to essentially mitigate those risks and to reinvigorate growth, but perhaps also to support creation of jobs as a means to essentially achieve China's goal of achieving common prosperity. Now, briefly, what we saw in terms of policy, macroeconomic policies last year, there we see that both fiscal and monetary policy have supported growth in the context of essentially weak performance. We're showing here the fiscal deficit, the augmented fiscal deficit, which combines the headline budget deficit with several off-budgetary accounts. Up until November, you can see that essentially fiscal activity or fiscal support was similar in magnitude to what we saw in 2020. We expect this augmented deficit for the full year to be around 7.4% of GDP, so a quite significant support from the fiscal side, mostly in the form of tax, various tax measures, tax deferrals, and tax rebates, as well as public infrastructure investment. Now, despite this fairly sizable fiscal support, the impact on the economy was relatively muted, and that's largely due, and this is what we show here on the right-hand side, these are estimates that our team prepared of the fiscal multiplier. So this is the impact fiscal spending has on ultimately growth. And you can see we compare here the pre-pandemic period where a fiscal multiplier was close to 90. It's slowed down markedly, and I think our conjecture is here that this is largely due to mobility restrictions that have affected essentially broader economic activity and confidence, and therefore the impact of fiscal spending on broader investment and economic activity in the economy has been dampened, and therefore not being able to fully offset the decline, the weakening in domestic demand. Similarly, on the monetary front, we saw throughout the year a moderate easing of monetary policy with some modest rate cuts in key policy rates. However, as you can see from the right-hand side chart here, especially household demand, credit demand has been subdued, especially for mortgages. And that's, of course, directly related to what I spoke about with regard to the housing market and property sector, where consumer confidence and sales hence are down, and therefore credit demand has also been weak despite steps to ease monetary policy. Again, muting the impact this monetary policy support and accommodation had on growth. Now, towards the end of the year, and this leads towards sort of talking about what we expect for this year, we saw that policies have pivoted towards a more pro-growth stance for 2023. And I would argue this is true across several areas of policy, and including, of course, COVID-19 related public health policies, with the effective rollback of China's zero COVID policy in a relatively short period of time. It's true for the policies and regulatory steps in the property sector, where previous policies, regulations, the three red lines that were intended to curtail leverage in the sector have effectively been rolled back and replaced by policy support. Regulatory reform, in particular, the regulation of platform firms, where we do see some signals that after essentially 2 years of regulatory scrutiny, there is now a bit easier regulatory environment there. And then macroeconomic policies are also expected, at least from what we take from the Central Economic Work Conference in December. The signals point to continued support into 2023. Now, what is important here, and we've kind of tried to compare here how these policies have evolved over the last 4 years, and you can see that in the last 3 years up until last year, these policies in a way acted against each other, or in some cases combined in a way that dampened economic activity. And 2023 perhaps will be the first year where these policies are essentially broadly aligned to support a recovery. Now, with that, what we expect is, as Ayhan and also Hassan mentioned, we expect growth for China this year to recover to 4.3%, so quite significantly above both the average growth in the global economy and the average growth among emerging markets and developing economies. As such, China's economy is expected to contribute positively and more significantly than last year to the overall global growth and economic activity this year. Much of that will be led by recovery of domestic demand, with both consumption expected to recover and especially pent-up demand to be released, as these restrictions have been rolled back, especially after the first quarter and after the first wave of COVID-19 infections is going to subside and consumers really regain confidence. Investment is also expected to recover in part because the real estate sector and investment in housing and property is expected to, as I mentioned earlier, to have bottomed out and to recover at least modestly this year and to be less of a drag on overall investment activity. And then on top of that, we expect that also public sector and infrastructure investment will continue due to essentially continued policy support from the fiscal side. And then manufacturing investment hopefully will also remain relatively resilient and recover modestly after several years of basically subdued activity there. Now, offsetting that positive momentum on the domestic side is an expected decline in external demand against the backdrop of basically the context and dynamics that outlook that Ayhan presented on the global economy, where outside of China, all major economies developing and advanced economies are expected to slow down markedly next year. And that will, of course, weigh on the export-oriented manufacturing sector in China. Now, as in the case of the global economy, China's outlook is subject to several risks, both domestic and external. I think on the domestic side, a key uncertainty relates to the pandemic trajectory. We know that the rapid dismantling of COVID-related containment measures was accompanied by an equally rapid escalation of infections. But of course, the question is what will happen after the first wave subsides and for the rest of the year, and to what extent COVID-related disruptions will continue to weigh on activity for the remainder of the year. There's some uncertainty on policies with regard to the regulatory pivot towards a more pro-growth and pro-business stance, as well as to the perhaps not the direction of macroeconomic policy support, but the magnitude of that support, so that budget numbers, for example, will only be released in March. So we will only then see to what extent fiscal policies, for example, will continue to support growth and what magnitude of support can be expected. Now, on the external side, I don't think I need to spend much time because Ayhan already elaborated the multiple interconnected risks that face the global economy and outlook. Key, of course, is a risk of a global recession in the near term, and then perhaps more in the medium term, the risk of geoeconomic fragmentation and tensions that could, in the short run, actually weigh on investor sentiment and investment activity, and in the longer run, lead to a slower potential growth by weighing on productivity growth. And China, of course, I don't need to say much on that, is in the center of that risk, given its very prominent position in key global value chains. So that's a key risk in the global economy that could likely affect China's not just near-term outlook, but even medium-term growth prospects. Now, to the final message around policy priorities, and here again, some of this nicely resonates and echoes things that Ayhan presented in his presentation. But for China, of course, public health-related policies remain important to ensure a safer reopening that would be also less disruptive to economic activity, including through vaccination of vulnerable groups, effective case management and treatment. On the macroeconomic side, I think clearly with the economy expected to remain below potential this year, despite the expected recovery, there is a case for continued fiscal support, and China certainly has policy space to undertake such support or to provide such support, but redirecting that support from investment and support to enterprises, meaning tax cuts and tax measures, towards support to consumption and household would not just support a short-term recovery in demand, but also contribute to the sort of more medium-term rebalancing of the economy towards a more consumption-led growth model. On the monetary side, again, there is a case for continued monetary accommodation, given that especially core inflation remains relatively subdued in the case of China. But of course, policymakers will have to be vigilant and at the same time balance policy support to the recovery with the need to contain financial risks, given especially China's fairly high leverage and overall debt levels. And finally, in the property sector, following the positive steps in terms of providing liquidity support and lowering down payment requirements and mortgage rates to support demand, there is perhaps a need for more decisive action and additional action to protect home buyers by increasing the funding to enable completion of troubled projects and to enable a market-based restructuring of key corporates, which is essentially key to rebuilding confidence of home buyers in the sector. And then finally, the last group of policies aim more into the medium-term structural reforms to bolster China's potential growth, and that includes well-known priorities around a predictable regulatory environment, further quality opening up in line with the commitments the authorities recently reinforced including in the Central Economic Work Conference in December, and to create a level playing field between private sector enterprises, foreign and domestic, and the state-owned sector. Secondly, strengthening of social security, safety nets, both as a matter of social policy to mitigate risks and shocks and the impacts of shocks on the most vulnerable, but also to bolster essentially or support the rebalancing of the economy towards a more consumption-led growth model. And then finally, catalyzing the transition towards a greener growth model through the application of market-based instruments and pricing using China's existing emissions trading scheme that was launched last year, and public investment in climate-smart infrastructure, where again, of course, additional stimulus measures would offer an opportunity not just to support a short-term recovery, but also contribute to a medium-term objective of the authorities to move towards a more low-carbon and climate-resilient economy. With that, I would like to thank you very much. And like in the case of Ayhan, I would very much encourage you to check out the China Economic Update called Navigating Uncertainty that we launched in December and that you can find on our website. Thank you very much, and back over to you.